Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 141st VideoCast, 131st podcast for the week ending June 30th, 2022. We're just coming off the worst first half of the year in over 50 years. That's the bad news. We'll talk about some of the good news moving forward. That's the S&P results history. But we've got some really good news, actually, both, I think, on the markets front. But more importantly, tomorrow I'll sit down with Philip Vasilou over at Legatum. And if you recall, maybe over a month ago, I did a segment on our VideoCast about the Chandler brothers, Richard and Chris Chandler. And tomorrow we're going to have the opportunity to do some question and answer with Chris Chandler's CIO, Chief Investment Officer of the Legatum Fund, and that's Chris Chandler's fund. And Philip has an extensive background. He's a partner in the firm. He's got skin in the game. He's been with them now for 16 years, since 2006 when Legatum started. And his background, he was at Goldman Sachs in London and New York, and then he worked for the Dubai Development Investment Authority. So he's going to give us some insights. Not only how did they turn $10 million, the brothers, into $5 billion over 2 decades, but what are they investing in now? And how has their philosophy changed or stayed the same since that benchmark in 2006 when they went into two separate funds? But just to put this in perspective, for those of you thinking, well, yeah, if I started with $10 million, I could get rich too. That's backward thinking, because if you actually do the math, it's 500x over 20 years. So if you started, with $100, for those of you who are, really in a tough situation, you'd get $50,000. If you started with 1,000, you'd get 500,000. Which is some serious coin if you're only starting with $1,000. If you started with $10,000, you would get to $5 million. That gets you to a pretty nice retirement. And then if you started with 100,000, using their philosophies and having their returns, you would wind up with 50 million, which is reasonably wealthy for most people. If you started with $1 million, which many have in their 401k after a lifetime of working, you could wind up with $500 million. And as they started with 10 million, they got to 5 billion. And I know there are a decent number of people I know personally listen to this video cast that have well more than 100 million. That if you started with 100 million, you would wind up with 50 billion over 20 years. Not to say it can be easily replicated, or that everyone who listens to the interview and reads the article are going to be getting the same type of results. But even if you got 1/10 of that and put it to work, I think you're going to see incredible results over time. Their key has always been, buying at the right price, deep value, but also concentration, knowing what they own, etc. So we're going to get into that. This is a good primer if you want to read this, because we're going to record and then we'll post at our normal time next Thursday for the VideoCast. Will be episode number 142. And also want to thank Gabe Farhadian, who listens to our VideoCast. He, I believe, sent it to one of the higher ups at Legatum, and then it kind of worked its way through the chain, and their comms guy, Daniel O'Neill, reached out to me to set up the interview. So, it just goes to show that you never know who's listening, and it's been phenomenal, and it's nice to have them all as subscribers to the podcast. I'm honored and humbled, to say the least. But this is the article from Institutional Investor that was out in March 16, 2016. The title is called Secrets of Sovereign. It'd probably be very useful to listen, to read that ahead of next week's VideoCast, because we'll cover some of the historic investments, but we want to cover try to get into more of what they're doing today versus what they did in the past. And very, very excited. Today's video cast, in that context, getting ready for tomorrow, is going to be much shorter. We're going to just get to the point of stuff, and then next week's will be more extensive. Also, any media that I do between now and next Thursday won't be acknowledged on that video cast. It'll be acknowledged the following week, just to keep everyone a heads up. Last week we had a super long video cast, an hour and 22 minutes. If you have a chance to check that out, if you missed it, do that. But we did not have time to cover the Ask Me Anything questions. So I want to cover them at the beginning this week, against our normal trend, just to get to them, because these, I guess in both cases, gentlemen took the time out to write good questions. So first is from Drew. He does not specify first name only. So Drew Byrne wrote, hi, Tom. Really appreciate your very important video cast last week to explain the Cooper Standard. It was stock changes, or some might say ball drop. Okay, so this was when Cooper Standard put out the note that they were retaining Goldman Sachs to handle the refinancing of their debt. The market took it as restructuring. It's since worked its way back up, but we did use the opportunity to buy stock. I think it dropped down to like $3.80. It's back up over $5. The other thing that is going on is that Cooper Standard was being, in the Russell rebalancing, which is now completed, they were coming out of the Russell index because their market cap had fallen from, $3 billion, which we think or $2.5 billion, which we think it goes back to over the next 3 to 5 years, to 70 million, where we had an opportunity to buy over 2.1% of the company. So so I think half of the selling was from people who didn't read the headline. The other half was just institutions getting it off of their books before the rebalancing. Now that artificial selling pressure is in the rearview mirror, that rebalancing is done. Now today is, end of quarter for the market in general. Just ignore the end of quarter noise. The last day of the quarter never makes any sense, or in this case, the half. Okay. So Drew says, I'm also planning to sell the stock in my tax-free account to rotate into, sell stock in my tax-free account to rotate into CPS if the stock price drops enough, and was reassured to hear you're on similar strategy. The CPS investment is money I'm comfortable with, even if it went to zero, but such potential opportunities don't often come around. Very grateful for you sharing your opinion on this. My question is, what is your rough threshold percentage reduction from here where you'd be comfortable adding more CPS stock, e.g. if this price dipped to 350, 375 before the next rate hikes? Would you consider adding, as there would likely be further downside from there with rate hikes, and if so, what percentage would you add? Rate hikes has nothing to do with this idea whatsoever, and will have zero impact on the stock. I believe, as I've said in recent podcasts and videocasts, that more than the amount of rate hikes that we're going to get has already been priced in. Meaning, look at the 2-year yield. It was up at 310. We're at 150. Maybe we get another 75 and another 50. That puts us at 275. It's already more than priced in. So if you think every time they hike rates, the market's going to crash, you're mistaken. As a matter of fact, there's an article out this week on biotech that says just that. And when you look at the data, it's completely false and absolutely wrong. And we're going to spend some time on that. So, and there would likely be further downside from there. What percentage would you add? My thinking is that I don't want to deploy further dry powder too early, as I have a decent position to date, and in case the stock went to $1 or $2. I'm also trying to gauge the likely effect of further planned Fed hikes on the stock price to help plan future CPS purchases in my tax-free account. I'd appreciate your thoughts, as I hadn't known about you at the time of Range Resources multi-bagger, so I haven't got that experience to draw on. By the way, there have been several news articles on 2-year waiting lists for many cars in the UK and Europe too, especially EVs with huge order demand, as you well know. Given CPS is a major European supplier, there's likely great potential there when chips flood back. Thanks again for your stellar weekly content. Hedge fund tips by far is the media highlight of my week. All the best, Drew. All right. Well, thank you, Drew, and thank you for your continued support. I know you're one of the consistent people who comment and like on social media and also on YouTube for the videos, so I appreciate that. I know many people watch these videos on the Hedge Fund Tips site, so they don't know how to comment. You have to click the link in the video to get to YouTube, and then you can leave your comments below. I wouldn't get too cute about this. As a matter of fact, someone put a comment on last week's video after CPS rallied from like 380 to 560 or something like that. I hope CPS falls again so I can buy some. And the point of the fact is, if and when Cooper Standard falls to $3 or $1, what people don't account for is there's always a reason. So that fear that's going to be in the market is what caused the person who left that comment last week to say that, because they obviously missed it at 380 when they had, 4 weeks ahead of advance notice when we talked about it and we said it could go to 1 before it goes to 100, and it could also go to 0, which we've emphasized over and over. This is not a free lunch. This is pricing in bankruptcy, with the bonds, up from 40 to 50 cents. That's a positive sign, but at the same time, we are running against the clock in terms of 350 million term loan comes due at the end of next year, number one, and number two, we're betting that the chips are going to come in quickly. We do know what the business looks like in terms of the operational leverage. If you look the first quarter after the pandemic crash, the company did 40 million of EBITDA, and it went from, $8 to $44 in one quarter. We do think we're going to have a very good probability. Remember, amateurs deal in absolutes, professionals deal in probabilities. We think we have a very high probability of seeing 1, 2, or 3 quarters like that before the refinancing. We also know that many investment banks are choking on about $80 billion of LBO debt that they guaranteed for the likes of Apollo, for the likes of private equity firms in December and January when credit markets were wide open and there was no care in the world. What that means is they guaranteed certain pricing, so the bank has to eat it. And there's 80 billion of those losses, which means all the people that were choking on that when times were good are now taking the losses, which means what? They're not backstopping anything, which means the credit markets are basically closed, with a few exceptions that I know of that were on the other side of many of those trades in December and January. I think Goldman is one that could backstop a deal because they're in a better position and they usually don't get caught on the wrong side of the excesses. And maybe a couple of the Swiss banks could probably do a similar situation because they didn't get caught on the wrong side in December and January. But by and large, across the board, they got to work through that stuff. I do believe the credit markets are going to reopen relatively quickly once the equity markets bounce back. I think that's going to be a function of now inflation expectations rolling over. We're going to talk about that today. As well as I think earnings are going to be less bad than feared. People are concerned about margins. People are concerned about estimates have to come down dramatically in the next 3 weeks. And I think they're going to be a lot less bad than feared. And that will fuel what could be a summer rally that will start to unlock credit markets. And I think Cooper will be able to get out in that window before the end of the year. But there's no telling that they can't. Now, what's the margin of safety? They have a lot of outs. In poker, we talk about outs when you have a hand. And the outs they have is of the $750 million of property, plant, and equipment. I estimate about 20% of that they could do sale leasebacks like they did in Germany. They got 50 million, which is more than expected. So call it $125 million on that front if they had to, plus the sale leaseback, plus the $425 million liquidity that they have right now. That takes them to 550. They only need 350 or 325 or 350. Anyway, ample liquidity. They also, don't forget their contracts now. They're getting a lot of retroactive pay coming back, number one. So they're not going to be burning cash as much. And going forward, they've got, as of the last quarter, 60% in index-based contracts. I think that's going to be higher at the end of Q2. So let's say it goes to 70%. So their margins are going to increase dramatically. And then finally, this is my covert green play because they get 20% more per car from EVs than they do from internal combustion engines. My models are on the basis of internal combustion engine, but they do have 4 of the top 5 EV platforms as their customers. And you saw, Ford is selling the heck out of that Mustang, et cetera, that Mustang car, truck, whatever you want to call it. So if EVs do accelerate, which I'm agnostic about, I just think it's cool that we have a covert green play. If it doesn't work, our base case is based on ICEs. If it does work, we can make even more money than we expect. So as far as like what percentage does it have to fall and why, it really just depends on the news, and it depends on the timing. How much more I'd be willing to buy in June of next year, if it's falling to $1 in June of next year, is going to vary much greater than if it falls to $1 next month. Next month, they still got a huge runway. So what would be the catalyst for it to fall that much? I'd have to see. Maybe they, one of their, whatever it happens to be. And then based on the information, I decide how much of stocks that I have in my portfolio that I think are going to be doubles over the next 3 years or 2 years am I going to sell off to create the cash to buy something that I think could be, 10, 15, 20 plus bagger. And that's how I'll determine it. So it's dynamic. It's not some formula like a stop loss where they teach all the retail traders to lose their money consistently. It is, it's based on, decades of experience is basically what it comes down to. You have to live through these different periods in history and study companies that have been through similar situations, like Tenneco from 2001 to 2003, where Munger made 8x in 14 months. When they inflect fast and hard. Dealer inventories are at 25 days worth of stock versus 70 days pre-pandemic. So there's a lot of backlog, even if we do go into a shallow recession, that needs to be restored, as quickly as possible. So all of these things are in play in our thesis. But to answer your question, I have the position I want now. So if it ran away from me here, I'd be super excited and elated that I never got to buy more. If we did get 1 or 2 more news events or market events or just nonsense or some fund blowing up that has to blow out of their position, we would look at, again, what the highest and best use of capital on a risk adjusted basis, probability weighted, is how we would think about it. So whether it's, and I've never gone all into a position at once or all out of a position at once. It's always phasing into my position over time and phasing out of my position over time. I'll be taking some off at, at 7x. I'll be taking some off at, 10 to 12x. I'll be taking some off at 18x. And hopefully I'll be taking some off at 25 or 30x, a very small portion of tail that I like to leave on when I think that it can go higher, but I'm not sure about other situations. So that is a long answer to a relatively long question, but a good question. So I do appreciate you sending that. And that's that. So DH sends a thing. Hi, Tom. I wanted to get your thoughts on using the CFA for a potential job at a hedge fund. I'm almost done with university and currently working at a capital markets analyst intern at a real estate investment firm, $3 billion under management. I come from a non-target school in Florida and a decent GPA. I'm sitting for level 1 just before graduation. Although the fundamentals are roughly the same, I'm more passionate about equity markets than real estate. Do you think the switch is probable, and how much more do you think the CFA will help based on your experience? You'll never use the CFA to get a job at a hedge fund. That's table stakes. If you don't have experience in business or a track record of success in investing, an MBA or a CFA is kind of like table stakes. Everyone has that. If you really like the equity markets, you should be getting the CFA for yourself. If you're, new to investing and you don't have a decade more of experience and have lived through and managed money through several cycles, that's your starting point. And that'll really tell you whether you like the markets or not, or you just think that the grass is greener. The grass is always going to be greenest where you water it. So, just flip through the Forbes 400. There are plenty of people that make a lot more in real estate than do in hedge funds. And there are people in hedge funds that make more than real estate people. But if you're passionate about it, you should just get the CFA for yourself. And if that happens to lead to a job, fantastic. Coming from a non-target school, the thing about finance is, I would say finance and law is people are giving you their money. In finance and in law, they're trusting you to solve a major problem for them. So their quick go-to is going to be, where did you go to school? They want to size you up in like a minute just to see, what they think it means to be smart. I'll take street smart over book smart any day of the week, but that's just not the way the world works. So the only disadvantage of going to a non-target school is just getting your foot in the door. Once you get your foot in the door, it's all about performance. So in that case, I would say you probably can come out of an Ivy and through your network get your foot in the door at a hedge fund, and then maybe later get your CFA, or just if you haven't, if you've learned enough and you can do competent analysis, maybe you don't have to get your CFA. But coming out of a non-target school, I would do that because that's going to give you some cachet that maybe you don't have coming out of a non-target school. And it shows initiative, number one, and it shows that you actually are passionate, not just some kid that wants to make a lot of money but isn't willing to do the work. So, if what you say is true and you love the markets, and this is then do it for yourself. And in the meantime, hustle and try to get your foot in the door, even if you're in the mailroom, and start to add value and start to show that that your value add and your ideas work, and they're thorough and they show diligence and work, not just putting garbage together and seeing what sticks against the wall, which I do see from a lot of people that reach out to me. So, look. You figured out how to get into a real estate firm that has $3 billion under management and intern there. So obviously you're smart enough to do that. You're going to be smart enough to get into a hedge fund if that's what you want to do. And I think you'll do it. So I think you're on the right track. And start to educate yourself, not for the benefit of your employer, but for the benefit of yourself. Because that's ultimately what's going to matter in the long term. And thanks for the great question. All right. Moving right along, media this week, want to thank Amruta Kandikar and Sriyashi Senyal for including me in their article on Reuters. This was 3 days ago. I said, quote, "I think there's an overwhelming feeling that inflation may be coming down and the Fed may not have to be as aggressive as anticipated moving forward." Said Tom Hayes. "As early as a week ago, unequivocally, everyone did feel that 75 basis points was guaranteed. I think now those probabilities have come down a little bit, and it's kind of an open story." And I think that's where we are moving into the next Fed meeting in July. I saw this on Market Watch. It says the Market Watch 50 2022 nominees. Submit your nominee. Market Watch is now accepting nominations for the 50 most influential individuals in financial markets today. The Market Watch 50 will be made up of people whose actions and opinions impact the markets, moving price of stocks, influencing strategies of market participants, and determining how markets function. They are the traders, investors, policymakers, CEOs, and influencers who made a difference in 2022. The deadline for submissions is September 1st, 2022. If you found this VideoCast podcast and research notes helpful, and you think it's deserved, you should, I'd invite you to nominate me. And here's why. The more people that listen to this, the more incentive I have to keep putting it out every single week, free of charge, for the benefit of a broad spectrum, from people that are centimillionaires and in some cases billionaires that are listening to this, and some of the new people like you just heard from DH, who's applying for his first job at a hedge fund. The bigger the audience, the more incentive and the more effort and the more time that we want to invest to keep moving forward and growing this. So if it makes sense and if it's from your heart that it has had an impact for you over the last month or year or 2 years, then go ahead and drop that in there. I'd be very grateful for that. Moving along, quote of the day: the intelligent investor is a realist who sells to the optimist and buys from the pessimist. Well, there's no question we've mastered selling from the pessimists. For those of you who've been with us, we've had some opportunities to sell to the optimists in the case of energy, in the case of banks, when we were buying from the pessimists in 2020. So now we're going to do that with China Tech. We're going to do it with biotech and hopefully with Cooper Standard in coming years. This was very interesting from John Kicklighter. In a distinct contrast to most major Western indices, China's Shanghai Composite is close to returning to a technical, quote, bull market, a 20% recovery from cyclical lows on a daily close basis in this case. So this was from 2 days ago, and I think that story is just beginning. Who would have thunk in March, in the midst of the chaos, when JP Morgan was putting out their uninvestable note, and which created the opportunity for us to, triple the size and dramatically reduce the basis and set us up for an unbelievable setup here into the back half. So that's that. So now we're going to go through some China stuff just to keep you updated and try to get through this one quickly. Beijing offers cash subsidies to spur demand for new energy cars. So we're going to see more and more stimulus. Beijing reopens schools for more students as COVID eases. All this stuff happened this week. By the way, I think today they were opening Shanghai Disneyland, which is kind of symbolic and very, very important. If it's not today, it's in the works. Apple supplier Foxconn starts new hiring spree at world's largest iPhone factory in China ahead of next product launch. So that's good to see for Apple. That's a bellwether for the S&P with the weighting in the S&P. So if that's true, that will be a positive thing in coming quarters. China's economy improves in June from lockdown-induced slump. Aggregate indicator returns to neutral after 2-month drop. Car sales picked up in June, but home sales still down. So you can see some of this truck traffic picking up in the different cities off of the lockdown lows. So that's very exciting. Happier small firms. You're seeing stocks rise on optimism about the domestic recovery. Here's small business confidence has shot up. Steel rebar inventory. Let's see. Onshore stocks shot up looks like about 10% there. Car sales improve. So, and their inflation continues to come down, in part because they are buying all of Russia's oil at massive discounts. So we've created a strategic advantage for China to build their SPR while we continue to suffer massive pain at the pump, unintended consequences of poorly thought out policy. Car sales, you see them just stair-stepping higher off the last couple of months since the lockdown ended. Real estate sales percent, they're starting to come back up. Steel, etc. So all these things that we anticipated would happen are starting to play out. Chinese fintech giant Ant Group appoints risk control veteran as executive in consumer lending arm amid restructuring. So Kui Zhaowen, a former risk strategy management executive at Ant's microlending business, is now vice president of Chongqing Ant Consumer Finance. There's been increasing speculation that Ant, which abruptly canceled its IPO in Shanghai and Hong Kong in 2020, is nearing the end of a long restructuring. So that's going to be a big deal if we can get that IPO out before the end of the year. We own a third of that as owners of Baba. That is not priced in the stock at these levels. It could be a huge thing. Bloomberg Law, one of China's top tech investors, see crackdown turning point. reassuring messages on regulatory front a boost. This is Fred Hu. He is the Primavera chairman and a rainmaker who started the $17 billion Chinese private equity firm Primavera Capital. Said reassuring messages concerning regulation, resilient earnings, and beaten down valuations now make the sector interesting for investors. This was the guy on the cover a couple of months ago that was worried about the future. Now he has turned. Opinion follows trend, which is positive to see. China, and he's huge. I think that's the largest private equity fund in China. China loosens its COVID quarantine rules. These travel stocks are flying. You all saw that. U.S. eyes Biden-Xi meeting in the next few weeks. See growing convergence on China. That's from 2 days ago. They're going to do a call. It's largely anticipated he is going to take off some of the tariffs on the $300 billion of goods to lower prices for American consumers. That will probably be met with a reciprocal goodwill effect. And we saw some indication and signaling to that effect today, where this headline from Reuters said China to extend tariff exemptions on some U.S. products. So they're probably getting ahead of it. You know, tit for tat. You're going to be nice to us. We're going to be nice to you. Good things can happen if that trend persists. China stocks outperform on unexpected COVID shift. Bullish calls are rising on Chinese stocks as the CSI 300 index inches near bull market, just below 20% gain. The last time it went from that negative to that positive was 2014 and 2015, and good things, really good things happened. If you go back to the Alibaba chart, the thing was up 200 some odd percent. So that's a positive thing as sentiment changes. Shanghai reopening as restaurants restart offering dine-in services. They want to keep it open. They will keep it open, but that's good to see. The restaurants are opening, not just the schools. China's central bank reinforces jobs and inflation goals. PBOC meeting. This is from yesterday rather. Removes pledge to keep debt ratio stable. Policy committee vows to step up loan support to small firms. In other words, they're throwing out all rules out the window to ramp up the economy with their forceful stimulus. That was the most viral Twitter tweet that I've ever done. Went crazy with the amount of likes and retweets and everything else. So thanks for that. Forceful stimulus. Everyone loved that. All right. Anyway, so the People's Bank of China reiterated a pledge to provide stronger monetary policy support for the economy, emphasize goals to stabilize jobs and inflation, and providing further signals it will focus on boosting credit growth. That's for consumption. That's where Alibaba benefits. PBOC will coordinate work on stabilizing unemployment and prices. Global. Governor Yi signaled in an interview this week that monetary stimulus would likely focus on boosting credit. Goldman Sachs suggests that policymakers might aim to accelerate credit growth in the near term. Take advantage of a rise. Central bank will also take advantage of a rise in domestic grain supply and stable energy markets to keep prices basically stable. They have stable energy markets and grains because they've been buying from Russia while we've been cutting off. So they're benefiting from our sanctions. And we're just pumping money and a strategic advantage into China. For now, it's been since January. So, going on 6 months. And that looks like it's going to continue to happen. Official jobless rates reaffirmed. Any boost to sentiment will depend on how the government manages COVID outbreaks moving forward. Ease some rules this week. Future income. Loan. A gauge measuring the looseness of monetary policy in the eyes of bankers climbed for the second straight quarter, with 40% of respondents saying the policy was loose, up 13 percentage points from the previous quarter. Et cetera, et cetera, et cetera. So all the things we said were coming are coming. China allows Kanzun and full truck alliance apps to resume user registration. This is a big deal. Again, another check on the box for the regulatory crackdown winding down. These, like Didi, they were forced to stop using their apps and signing up new users. Now the government has allowed them to begin doing that, so they're back operating as normal. China eases quarantine restrictions for travelers. I think they took it from 21 days down to 10. Why it might be time to bet on Las Vegas Sands. We own Las Vegas Sands. We certainly like that call, and we think over the next 2 or 3 years, that's a double with pretty good assurity. Moving forward, it's just too cheap at these levels, and they've got a great moat. If you've actually ever been to this, I don't have the picture here, but if you've been to the Sands in Macau, which I have, it's a sight to be seen. Like, they have these crystal chandeliers, like, that are like maybe 100 feet all through. It's like a football field of casino tables. Absolutely unbelievable, right in the center of Macau. So we agree with that call. China continues to snap up Russian coal at steep discounts. So not only are they loading up on energy and coal, so they may actually be able to do two things. Number one, use their forceful stimulus to get 5.5% GDP growth this year, as Xi has commanded his lieutenants to do, no matter what, despite the fact they were shut down for 2 or 3 or 4 months, depending on the area. But they might be able to avoid massive inflation despite all the stimulus. Why? Because they're buying their energy at a monstrous discount, unlike the rest of the world, who is paying a premium. So energy is the input cost for everything. China now has a clear strategic advantage, buying as much as they want from Russia at tremendous discounts. So that is a big deal moving forward. And China tech investor defies skeptics with $900 million fundraise. China-focused venture firm poised to raise about $900 million for a new fund focusing on investment in China. A rare feat amid skepticism about the political and market risk of Asia, the largest economy. So, these guys, the smart guys, are figuring it out. They're going in now. The dumb guys will be in 2 years after everything's recovered. But and there'll be a lot more in 2 years than there are now. But, some of the super smart guys, like that guy with the largest private equity firm, and this guy raising a fund, and Dalio's been in there like crazy. U.S. listed, full truck resume user registrations. We covered that. China's factory activity expands for the first time in 4 months. The official PMI came out this morning, rose to 50.2. Anything above 50 is expansion, and it was 49.6 in May, which was contraction when they were shut down. So that's a move in the right direction. China home sales slump eases in June after support measures. So local governments eased buying curbs, cut mortgage rates, and partially relaxed ownership rules. So they're trying to stimulate everything. China's world-beating stock market rally is forecast to strengthen even more. About 70% of poll participants will maintain or boost holdings. Share indices in China and Hong Kong seen rising at least 4%. It's official. Chinese equities are once again in vogue after months of regulatory crackdowns. Opinion follows trend. This is funny. This one's from Bloomberg News. No one's even willing to put their name on a positive article about China. They just do it from the board. Anyway, Chinese equities are once again in vogue after months of regulatory crackdowns, deleveraging, and stringent virus curbs wiped out trillions of dollars off benchmark gauges. A Bloomberg survey of 19 fund managers and analysts predicts that benchmark stock indices of China and Hong Kong will post gains of at least 4% by year end to outperform their global peers. About 70% of those polled plan to maintain or boost holdings of shares in mainland and financial hub in the next 3 months. Optimism marks a stunning reversal from March, when investors raced to trim exposure into the uninvestable note from JP Morgan to Chinese assets on fears that the nation's COVID lockdowns and the war on Ukraine would dampen economic growth. A recent easing of virus restrictions has propelled the CSI 300 to the brink of a bull market, and a loose policy stance has helped local equities defy the recent sell-off in global stocks. COVID restrictions will gradually ease under the backdrop of stability as the overreaching priority. The government may provide a relatively loose monetary environment in the second half with liquidity benefiting stocks, as Fang Rui, managing director at Shanghai Wu Sheng Investment Management Partnership. We're quite optimistic on valuation recovery, also lifting the indices higher. Survey of investors and analysts in China and Hong Kong sees the Shanghai Composite rising 4.6 and 4.4 for the year. They expect an 8% advance for the Hang Seng, which is the tech heavy. Anticipate further policy steps to boost growth. This is not optimism, by the way. This is like coming out of the bunker. They'll get more optimistic as the price goes up. Trust me. The optimism is reflected in recent China bouncing shares, rallying about 19% from an April low after Beijing lifted the lockdowns in major cities. BABA was up some 50% off their March lows, and it's just getting started in our view. Momentum also turning more positive on U.S. listed Chinese stock, with the Nasdaq Golden Dragon Index poised for its first quarterly gain in more than a year. The same thing happened in 2009, ladies and gentlemen, and that is the Chinese indices bottomed 3 or 4 months before the U.S. indices. So extrapolating that forward, if that holds true this time, that would mean the U.S. indices bottom in June or early July. I think that's a reasonable expectation, and we'll go into why as we move along here. That's fueled a rush of buying as global funds purchased a net 73 billion yuan, $10.9 billion of onshore stocks via trading links in June, the largest monthly inflow since December. Capital flows into China are set to get a further boost when dozens of mainland listed ETFs are made available to overseas investors through Stock Connect program starting July 4th. That's interesting. Set to get a further boost. Okay, a good run. China stocks outperformed global peers by the most since late 2014 this quarter. That's very positive to see. You don't get these lines up without a massive move in BABA and other bellwethers like Tencent, JD, etc. The upbeat forecast for Chinese equities contrasts with the more negative outlook for U.S. stocks, with Morgan Stanley, Goldman Sachs among those predicting Wall Street will see further declines, etc. So weaker yuan, equity versus bonds, so that you get the story there. Hang Seng, China's tech stocks are the most attractive in the world, Invesco says. Mind you, this is coming out after BABA's up 50% off the bottom. Just saying, opinion follows trend. But this is still going to be a great call because it hasn't even started. So China is the best place to buy tech stocks as valuations in the U.S. remain too high to be attractive, according to Invesco. Beijing's crackdown on everything from tech to property to online education sparked a year of heavy selling that wiped out $2 trillion from the Hang Seng Tech Index at the height of the rout. That's now reversing as loose monetary policy and an improving growth outlook outweighs concerns about the country's COVID-0 policy, and firm's global head of asset allocation research, Paul Jackson, said in an interview. The slump opened up a valuation point where the market is trading in a low range historically in absolute terms at almost half compared to the U.S., said Jackson at Invesco, which oversees about $1.45 trillion in assets. If you're going to buy tech stocks, it's best to do so in China. Okay, so, et cetera, et cetera, et cetera. So, I think, by the way, the U.S. is trading heavy because people are expecting this next shoe to drop where they think that the earnings, so when you say it's trading at, the S&P is trading at, 14.7 times next year's earnings, that's cheap. Well, people will come back and say, well, that's because the E is not true. The E is going to come down. I think what people are underestimating about China is they say, wow, the multiples are low. That's a good thing on a relative basis. But what they're underestimating is how much the E is going to go back up now that the crackdown is over, now that the stimulus is starting to kick in, now that the cities are starting to open up. I think the E is going to explode, which is going to make the multiples have to catch up to that level of growth. So I think it's kind of the inverse of what you're seeing in the United States. Michael Burry of Big Short fame warns the Fed may alter course. That shouldn't be a warning. That should be an opportunity. And that's what we said before Michael Burry said it, which is that like 1994, where they did the 75 basis point cut in December, 8 months later in July of 1995, they were cutting again. And I think we're going to see the exact same situation happening. If not, probably by early next year, we'll see the first Fed cut. as things start to stabilize and inflation continues to roll over. Wall Street's favorite stock sector has potential upside of 43% as we enter the second half of 2022. I tend to agree with this. One of the things we do every week when Carter puts out the earnings is we go through stock by stock, see which ones are being revised up and revised down and what's happening relative to price. And consumer discretionary, price change, the sector's down 32% year to date. I think the earnings are too low. Decline in forward PE is down 26%. But if you look on at the top 30 weights, starting with Amazon, I've been emphasizing this throughout this period. I think when you look back 3 to 5 years from now, Amazon is going to be one of the greatest opportunities that came out of 2022. Aptiv, I don't know it very well, but we've been looking at that. AutoZone's already had a run because everyone's anticipating a recession, that people are going to keep their 13-year-old cars and keep repairing them. Part of that's true, but dealer inventories need to be rebuilt, and there's still a backlog for new cars. Best Buy, one of our listeners, Jacob L., did a great presentation, actually sent me a solid deck. And the thing that I'm skeptical, I like the thesis, and his analysis was fantastic. The thing that is very important to me when I go into a new position is not just that it's cheap and it should revert back to the mean, is what are the specific catalysts that are going to cause a change and have the stock be re-rated and get back to a normalized multiple. Right now, I don't see any catalysts that are going to re-rate Best Buy, despite having a great return on invested capital over time, great management. They did the restructuring 10 years ago, etc. There's no catalyst. Now, if you said to me, it's fine, just wait on it 3 to 5 years, it's going to double. I think that's probably true, but I like near-term catalysts. With Cooper Standard, I know exactly what needs to happen. The chips need to come in. They need to have a monster quarter like they had before the shortage started after the pandemic drop. They need, and then from there, people are going to be clamoring to do their refinancing. That'll be the next catalyst once they do their refinancing. That probably takes the stock into the mid-20s. And then from there, then it's just a waiting game to get to that normalized EBITDA of $3.50, $9 a share, 10 to 20 multiple, 20 to 30 bagger. With Best Buy, I don't see what the catalyst is that's going to cause the market to re-rate it, other than just the market going up and people feeling better about the consumer, which could happen right away. But I do like this long-term thesis. I just don't know where it bottoms before it goes back up and makes new highs. So this one is like a long-term investment, very good, very solid thesis. But I think the key for getting interested in this would be define some catalysts. What would be some turning points that would have the stock re-rate? And the way you figure that out is go back through history, read all the earnings conference calls, read all of the analyst notes during the period of time that it was, trading at these ridiculously low multiples, and what changed that the multiple went back to normalized and the stock re-rated. And is there anything on the horizon that could do that? Or is just pessimism so acute that eventually has to return? But for something that has, a 1x or 1.5x upside, I need it to double much faster than 3 years. If it's, or 4 years. So I would need like a 3 bagger or 4 bagger to wait 3 to 5 years on just to get the right compound annual growth rate that's going to dramatically exceed the S&P net of fees. Otherwise, it's a bad use of capital. But I do think this will work, so that's worth continued investigation. I just don't know where it bottoms before it gets re-rated. Booking Holdings, again, look at these stocks, guys, and this is the sector that no one wants to touch. mark my words, 4 years ago, 4 years from now, when you look, down from $188 to $100, this is Amazon, folks. This has a moat. This has Amazon Web Services. This is the Alibaba of the United States. How could you resist? It's trading down. We used to, talk about Alibaba as the Amazon of China. Well, Amazon is the Alibaba of the United States. That's what we're going to be saying, trying to convince people to get back into U.S. tech in the next 6 months. Look how well Alibaba's doing. Imagine if you could own the Alibaba in the U.S. So that's that. Booking Holdings, that's a travel stock. I think this is going to be fine. These things have just been left for dead. Everyone assumes the consumer is completely dead. We're going into a severe recession or depression, and I think that's not going to be the case. Chipotle Mexican Group. This stock has just always been too expensive for me. It's kind of like Tesla. It goes in my too hard box. DHI, the housing stocks are the cheapest in the market. We're, getting closer and closer here. I know rates have gone up, but the key, as I've said for the last 6 months, is going to be those players. The shortage, we're underbuilt. The demand is exceeding the supply. You saw a taste of that in the last 2 years. Rising rates dampens that demand. But the key is they've been building these 4,000 to 6,000 square foot houses for the last 20 years, the Toll Brothers of the world, for baby boomers, because they were following the biggest part of the demography. Now the biggest part of the demography are the millennials, which are bigger than the boomers, which are 31 years old, and they don't need, they might like to have a 4,000 to 6,000 square foot house as their starter house, but they don't need a 4,000 to 6,000 square foot house. And if you look at the 70s, when the boomers were their age, they were all these 3-bedroom, 1-bath, 3-bedroom, 2-bath ranches. Think like Levittown, that was in the 50s, which was the last boom before then. We're going to see a massive amount of 1,200 to 2,000 square foot houses built. And the home builders that are going to focus on that market to meet the supply from the millennials, not what the millennials think they want, but what the millennials can afford, even at 5 or 6% rates, that's where the opportunity is going to be. So focus on the lower end home builders with a track record of success. And I think they're in the range of where, it can start to make sense to pick them up with the long view, because that demand is not going away. But again, it's the smaller houses that we've been talking about for some time. Dollar Tree, that's already moved. eBay, I would consider looking into it here. I'd have to understand the business a little bit better in modern days, but Expedia, again, another travel stock. No one's going to travel. Yeah, I'll take the other side of that trade. Ford. So, people that can't find things to do, that say everything's overvalued, are completely missing the boat. This is one sector to start with. Home Depot, we've covered in recent weeks. Not recent weeks. We covered it on the Clayman Countdown last week. Hilton, same travel story. Here's Lennar. Lowe's is the same story as Home Depot. Marriott, McDonald's. All right, what else do we have here? Nike, we covered last week. That's bottoming here. The overhang was China. China's coming back with a vengeance. Roth stores, I don't know well enough. I'd have to do some work. Starbucks, same story. China overhang. That thing's going to take off. Target, I'd have to look at it a little bit closer. But this is how pessimistic everything is on the consumer side. Tesla, this is interesting. Not for me, but I'd have to look at that. I mean, I can never bet against the guy. The question is, will I ever bet with him? I hope so, but we'll see. I don't think it's ready yet. I mean, the problem is I could easily see this breaking back out now if we get a summer rally, but that to me is it's too expensive for me. That's in the too hard box. Okay, moving right along. U.S. to ramp up military presence in Europe to counter Russia. Those of you who have given up on defense and aerospace, you just got to hang tight. And as a matter of fact, we're going to cover with Philip tomorrow, how many of their best money-making positions went against them huge. I think, I'm cuffing it here, but I think it was Japanese banks in the early 2000s. I don't have my notes in front of me. Were like one of the positions went 70% against them before it went up like 10x. And they didn't even blink. Why? Number one, there are three things that'll kill an investor, or a fortune. Ladies, liquor, and leverage is the old saying. Nowadays, I would say liquor and leverage still apply, and then depending on your starting sex, would be ladies or men, whatever you're into, and et cetera, et cetera, et cetera. But I think that's still holds true. If you don't have the leverage, you can withstand the short-term volatility that often makes zero sense relative to the underlying fundamentals. And that's usually because at those points of acute pain, there are funds blowing up and forced selling. It has nothing to do with the future prospects of the business. That has nothing to do with the PE multiple or the fundamental work that you did for 20 hours to find the greatest stock. I mean, a Best Buy, for instance, that thing could go down to 40 before it goes to 140. It has nothing to do with the underlying business. It just has to do with people get so pessimistic on the consumer, et cetera, et cetera, et cetera. But ultimately, the business will re-rate. It will revert to its norm. It is a well-run business. And it's the last one standing in the in-person tech. If you want to buy something or fix something that's not Apple, the only place you can go is Best Buy. So there is a nice little moat around that, and no one's really going to enter that space. Okay, so yeah, we're still bullish long-term on defensive. As we said, regardless of what happens with Russia, the commitments for NATO are going to go up. Everyone's going to be spending more on defense. All the contractors are going to do better and better and better. Oaktree's Howard Marks, who is finding bargains. I'm starting to behave aggressively. So that's that. Opinion follows trend. ECB to activate first line of defense in bond market on Friday. This is what we covered last week. They basically said we're doing quantitative easing again when we have to. So they didn't even get into quantitative tightening before they started buying bonds again. Raging U.S. inflation is starting to cool. Key price gauge signals. This is the key price gauge that the Fed watches most closely, which is the core CPE rate. And I think we have that right here. And you can see that it's now the third month in a row. This definitely looks like peak inflation. If we got a break from oil, we'd really, really be rocking it. And maybe MBS will show some mercy to our leaders as they go crawling on their knees to beg them to pump a little more oil. If they have the capacity to do so, we shall see. All right, moving right along. This is the article I wanted to cover. So the title is Big Pharma Won't Bail Out Battered Tech. While biotech market rout represents pharma companies with cheap targets, don't count on a handful of deals to turn into critical mass. The stock market, so basically it's taking aim directly at my thesis that number one, drug approvals will come back. And number two, the animal spirits started with Pfizer buying Biohaven, and we went through multiple deals last week that are just the start of this. Okay. Now, his core thesis to discredit our thesis, and he's not saying Tom Hayes of Great Hill Capital said XYZ, here's why he's wrong. He's saying that if you're expecting a rebound, basically he's piling onto the negativity along with those people selling in the hole. So what you need is articles like this to get the last few hopeful people out of their stock. You've got to steal the stock from these people that have been clinging to hope, take them fully out, and start fresh with people like me that come in and buy from these weakened sellers due to articles like this. This is just, whether it's coincident or causal or whatever, it happens every single time. You need the selling report, the sell side report from JP Morgan saying China stocks are uninvestable to take the very last few people. As a matter of fact, one person that used to send a lot of AMA questions about Alibaba that just basically threw in their hands at $75 now that Alibaba's back up 50%, they're DMing me on Twitter every day with a new positive article about Alibaba. And they got crushed. They sold in the hole. They've missed the first leg of the up rally. That's the bad news. The good news is there's still plenty more to go. The problem is the thing's probably going to shoot up maybe 130 or something like that. They'll finally get sucked back in. Then you'll get a rip back down to 110. They'll get taken out, and then you'll just run up to 200, and they'll have missed it and double loss selling in the hole 2 times. And that's just what the market does. It's designed to fool most of the people most of the time. And that's why you don't trade on leverage when you can avoid it, because you can just sit through this stuff knowing what you own if you've done the proper research and lived through enough cycles to win in these situations while other people are getting their heads handed to them. Now, I want to really get to this core argument that they make. Purchase price. Bargain prices. Okay. So when will the bleeding stop? XYZ of such and such capital management. I don't want to defame anyone here. The sector as a whole can't really begin to rebound until it is clear the Federal Reserve is finished raising rates. As of now, traders are pricing in rate cuts later next year, so that recovery could start as early as next year. Okay, the sector as a whole can't really begin to rebound until it's clear that the Federal Reserve has finished raising rates. So keep that in mind. Okay. Here we go. To an even greater degree than high growth tech companies such as Spotify or Roblox, biotech struggles in a rising rate environment because many companies don't have any real revenue streams and don't expect to have a product in the market for years. Sadly, for both investors and patients, clinical trials move slowly. Okay, so this is the core of their debunking the idea that biotech is going to rebound. Biotech struggles in a rising rate environment. Okay, just write that. Just mark that in your mind. Number 2, the sector as a whole can't really begin to rebound until it's clear that the Federal Reserve is finished raising rates. So that is their core thesis. Struggle in a rising interest rate environment. Okay, let's go to the facts. This was part of our thesis when we put it out weeks ago. And by the way, here's they said just because Pfizer bought Biohaven doesn't mean that animal spirits are going to be back. Well, just take a look at the facts. Here's another $2 billion deal. Here's another $2 billion deal. Here's another $4.1 billion deal. And we're going to see many, many more to come. That's number 1. And it's just starting. But here's the point that I wanted to get across. Here's the Fed funds rate. Okay, this is exactly what happened last time. In anticipation of rate hikes, okay, anticipation right here, the biotech sector fell some 50% from 2015 to early 2016. As the Fed started hiking rates, the biotech sector XBI ETF bottomed in early 2016, just as they started raising rates, okay? Now, what happened in 2021 to 2022? The same exact thing. In anticipation of the Fed raising rates, the sector cratered. Last time was 50%, this time was over 60% on the same fear, the same false premise that biotech struggles in a rising rate environment. Biotech doesn't struggle in a rising rate environment. Biotech struggles on the fear of a rising rate environment and actually does its best when rates are rising. So, this gentleman who said that the sector as a whole can't begin to rebound until it's clear that the Federal Reserve is finished, well, let's take a look at that. Okay, the sector bottomed when hikes actually began. The sector bottoms when hikes hikes actually began. What happened over the next 2.5 years in a rising rate environment is the sector appreciated 140% off of its lows in what? In a rising, here's the Fed funds rate, rising rate environment. So when it crashed in anticipation of the hikes, it had its biggest move as the hikes were going. From 25 basis points to 250 basis points, the sector went up 140%. That is the antithesis of what this article is telling people to get them out of their stocks at exactly the wrong time, selling in the hole, and getting screwed. So rethink and, be willing to be burdened by data before you make assertions that are patently false. And you just see it over and over. Now, I should be celebrating versus, giving them a hard time, because if there weren't articles like this, there wouldn't be opportunities that have made my career. So I'm grateful for when people are unwilling to burden themselves with the facts, because it creates opportunity for us to take advantage in the whole when everyone else is getting taken out of their stock when their last flicker of hope is being extinguished by faulty analysis like what you're seeing here. We're able to step in, hoover it up, and ride it back. And then as this rebounds back to here, it will be the exact same writers that initially are saying biotech is rallying, but, and then they'll say, what if the FDA never approves another drug? What if people never go back to their doctors? What if there are no more M&A deals for the rest of all time? And then after this doubles off the bottom and it's up 100%, they'll say, biotech sector looks like a reasonable investment opportunity moving forward. We think that valuations are reasonable, and if you take a long-term view, you will make a tremendous amount of money. And then back up here is when they'll say, there's never been an investment opportunity like biotech. The whole paradigm is changed with genetic testing and with DNA sequencing and CRISPR or whatever the new technology is going to be that they're going to hype around that time. And if you miss this opportunity, you will miss the technology that transformed the world as we know it forever. There will soon be pills in a bottle that you can buy in Walmart that will cure cancer. And at that point is when we will be laying off our stock. When these same commentators and media personalities that were super negative on energy and banks in 2020, that loved them at the top in recent weeks, telling you to buy the dips on these things before they crash 40% in 2 weeks. That's how we do it. And that's how you will learn to do it over time. And it takes some thick skin to deal through the short-term volatility. But just, ladies, leverage, and liquor are the three killers. Or if you're a lady, men, or if you're a lady who likes ladies, ladies, and if you're a man who likes men, I get the whole thing. But liquor and leverage, stay away from both of those, and you'll do just fine through these periods of volatility until your thesis plays out. So that's that. But I would just really want to reemphasize this, guys, so you don't miss this. Fear of hikes, actual hikes, 25 to 250. Fear of hikes, actual hikes, bottom goes in. And this note we put out May 5th. So this is what you want to focus on. Burden yourself with the fact. When you read an article like this that's negative with something you've done the work, just check it versus the data. What happens historically when these conditions are there? And it's just the opposite of what these people are telling you. And this is taking a ton of people out of their stock at the absolute worst time, which creates opportunity for people like us. And people like this. Hedge funds go bottom fishing for biopharma. This is from institutional investors. RA Capital, Perceptive, and Millennium are making big bets on beaten down stocks. So that's all you need to know. Here's the core PCE for 3 months in a row. Here's Biden says he'll ask Gulf Alliance to boost oil production. So he wanted to be very clear. He is not going hat in hand to Saudi Arabia. He is going to go to the, quote, Gulf Alliance to beg them for oil because he's choked off our producers and castigated them for doing what they're supposed to do, which is produce stuff, and made it as hard as humanly possible. So now he has to go beg these vicious, I don't know, whatever he called them, killers or whatever he called them before he got elected. Now he's got to go break bread with them and beg for their mercy. And it's sad, is really the answer to it. It's absolutely sad. So Tesla stock is set to post its worst first half ever. This is a perfect bellwether for exactly what's happening. So we're going to get into the article of the week where the G7, they're doubling down. They will not be deterred from their climate change timeline to get it decarbonized by 2030. Inflation, food prices, energy prices, be damned. Let the people eat cake. If bread is too expensive, let them eat cake. If they can't afford bread, if they can't afford to put gas in their cars, be damned. We're going to have solar panels whether the people like it or not. And slowly but surely, every single one of them will be voted out of office because people vote with their pocketbooks, and now they vote with their stomachs. So good luck with that. We're going to find out in November, number one. And number two, Macron has already gotten a taste. He's basically a zombie president, has no power based on the last election results. And he's handicapped himself. And the other 7 people standing in the pictures will face a similar fate unless they get pragmatic and say, hey, our intentions are noble. We want to decarbonize. I think everyone's on board. Even if you don't believe in climate change, you want the hedge. Like, what is the downside to decarbonizing, even if we're wrong? Like, if you look at 5,000-year data, you see these longer-term cycles, etc., that could presage an ice age before presages what they're... But the fact of the matter is, there's no downside to a massive hedge. I think most people are on the side that, we've had a 1 degree Celsius increase in temperature over the last 200 years. So that could be long-term cyclical, but what if it's not? And if it's not, we should take all the actions that we possibly can, but we should transition on a reasonable timeline, not to destroy people's livelihoods, ability to eat, ability to travel, ability to work, by trying to move too quickly, too fast. And Elon Musk has said the exact same thing, because he tends to be honest about what he says versus idealist. He's a pragmatist, and he said that why wouldn't you want the hedge in place if this continues to persist and it's not a long-term cyclical trend? We have the power to change our behaviors over time. We should change our behaviors over time, but to do it in the middle of a recession and to double down at the exact wrong time just shows a complete oblivion to economic principles of supply and demand. And we've just been through a once in 100-year event. Like, chill out. Like, hey, we were planning on 2030, but we had this thing called a pandemic. It happens every 100 years. It took us by surprise. So guess what? We're going to delay our timeline by 5 years. We're still going to give incentives for EVs. We're still going to do more solar panels and windmills. We're still going to do all the things to save the seals and the bears and all that stuff. But we're going to do it over a more reasonable timeline so that people in developing countries are not starving. People in the developed countries can actually afford to get to work. And we do it in a sensible way. They've chosen not to do that. They will be forced to make that decision. The market will force them, or the election polls will force them. But unfortunately, many politicians come to the correct conclusions only after all other alternatives are exhausted. And we saw that in China. They finally pivoted in March when the top 3 tech companies said we're laying off 20% of our workforce. They said, whoops, those are my voters. I'm toast. Let's change. And that's exactly what's going to take place here. The problem is they're just going to cause chaos for the next 6 months in the interim, but they'll figure out in November that was a costly decision. Top 10 buys of super investors over the last 2 quarters. This is like off of Data Roma, where you can see some of the top value investors, etc. I like this because it's a lot of the names that are on our radar. Top 10 buys. So they're digging into Meta platforms. We think Facebook is extremely cheap. They're digging into Amazon. We agree. Netflix, I can definitely see the story there, 100%. Carvana is down, from what, $300 to $30 or something, or $20. Used car sales are going to suffer from new car sales with all the supply coming online. But, at some of these levels, you have to start to take a look at these things. C is this Singaporean-based gaming company that's kind of like a China tech play. Proxy, Warner Brothers is a media thing that got shot. Citigroup, PayPal is super cheap. Moody's, Google. I don't think Microsoft's cheap enough yet, but it's a great business if you look at their historic multiples. But, again, these things are BABA, okay, top 10 buys the last 2 quarters, so people are starting to come into BABA. Comcast has gotten cheap. Here's a defense company. So I like to see some smart money coming into the names that we're in and are on our radar. Since hitting a peak of 5.3% in February, the core PCE has now dropped 60 basis points. This is the third favorable inflation reading in the last week after the Michigan inflation expectations were revised lower, and Germany's June CPI fell short. So that's good news. This is the Gallup poll of consumer confidence, lowest since the 2009 lows. You want to take the other side of that. They're running out of cars to sell in China. China's vehicle inventory alert index fell by 6.6 percentage points year on year, or 7.3 percentage points month on month to 49.5% in June, below official warning threshold. China Automotive Dealers Association. That's good for us. We like that as the number one sealer in the entire world around the windows and doors and that type of stuff. We covered last week. This is from Seth Goldman at SethCL on Twitter. Drewry's World Container Index decreased by 3%. We've covered that multiple times on our media appearances in the last couple of weeks, but you can see the shipping and other major input costs rolling over. This is from Ellie Terrett. Hey now, Fox Business. Fox Business Network overtakes CNBC as leader in business television. Who would have thunk? And of course, the Clayman Countdown, weekdays at 3 p.m., anchored by Liz Clayman, each achieved their most watched quarters since 2020 in total viewers. That was in the middle of the pandemic when people were locked in their houses and the market was falling and they had nothing else to do but look at the markets. So to get viewers that high is super exciting. Congratulations to Fox Business and Liz Clayman for that, and Ellie Terrett, who produces over there for them. Our commodities in a bear market, we covered this extensively last week. This is just another visual way to look at it. Prices are coming down. The last one to fall is energy. This was last Friday, by the way, and it's been forgotten, but Kramer was on Friday morning. I did the recording here. It's on Twitter. And, he confirmed that auto semiconductor shortage is ending. He confirmed the Jonas note from 2 weeks ago we've been talking about. That's good for OEM suppliers. We agree. But he also mentioned rumored, quote, hidden talks. A 30-page, quote, truce document was on the table regarding Russia-Ukraine. The market was up 800 points that day. And he was saying that was behind the recent energy collapse. So whether that's still in play or not, I find that those things kind of come and then disappear like a trial balloon until they actually play out. If that played out, no one is positioned for that. It would be the biggest shock in the market, and the S&P would probably be up to 4,800 within 6 to 8 weeks. And there would be panic buying and FOMO like you've never seen. That's certainly not evident in the markets this week, but then you got end of month, which gets a little nutty, so you can't really tell on the positioning. If this is still in play, it would be huge. And for him to put that out on national TV, I would hope he had some credible sources that's a possibility. It certainly didn't feel like that on the basis of the communique from the G7, which was basically doubling down on giving Ukraine unlimited money to drag this out for another 2 years. People just have to deal with food and energy prices, and that's that. That was basically the message of the G7. Let them eat cake, too bad. JP Morgan sees capitulation in retail crowd bailing on stocks. Small-time traders exiting equities at the fastest pace since 2020. All the gains amateurs made in the meme era have been wiped out. Some of the last bulls at the party are finally yielding to the bear market, bailing from stocks at the fastest rate in nearly 2 years. Retail investors who'd almost always bought the dip since the pandemic crash exited shares in the past week, with sales reaching the heaviest since September 2020. This was on June 23rd, so that was before that 800-point rally last Friday. And according to estimate by JP Morgan Chase, based on data on public exchanges. So they capitulated, threw in the towels last week. Market ripped higher. It's held above those lows. The exodus marks a notable shift for small-time traders who mostly hung on during the $15 trillion sell-off this year. Sentiment is finally cratering, with losses piling up in their favorite stocks as well as cryptocurrencies, said JP Morgan strategist Peng Chang. There's been a trend of weakening demand. It's fair to say that retail has capitulated. So, wow, I thought this was going to be a short podcast. It's turning into a long one. All right, Atlanta GDP ticked up this week and is historically more pessimistic than the official print. So, 2 consecutive quarters of negative GDP. If you remember last week, this was at 0%. It ticked up to 0.3%. This is usually more pessimistic, which probably makes it likely that the second quarter was not negative, in which case we didn't already have a recession. But we're going to find out soon enough. And that increases the odds of the soft landing scenario. So we'll see what happens. But that was a positive development this week. The G7 double down stock market and sentiment results are article of the week. Einstein once said, the definition of insanity is doing the same thing over and over and expecting different results. That's exactly what the G7 decided to do when they published their communique on Tuesday and drove the Dow down 500 points and energy prices up. This G7 has been compared to the meeting in 1979 that took place in Japan under the Jimmy Carter era, when there was also a global food and energy crisis. While in 1979, the G7 tried to limit imports from the Middle East, which failed immediately. This time they want to restrict imports from Russia. They intend to do this with a price cap, also known as a quota. This proposed alternative solution is to go hat in hand to Saudi Arabia and beg for more production, which Biden's going to do next week. Macron said they may not have the ability. Even if they did, they may just punish him and the rest of the world. This is the consequence of not being energy independent. And this is a complete embarrassment, considering under a totally different energy policy, the United States became the world's top crude oil producer in 2018 and maintained the lead position through 2020. Then the policy changed, and these are the results that you have. As Milton Friedman once cleverly said, quote, if you want to create a shortage of tomatoes, for example, just pass a law that retailers can't sell tomatoes for more than 2 cents per pound. Instantly, you'll have a tomato shortage. It's the same with oil or gas. Coming to a theater near you. With consumer confidence at all-time lows, the stock market in a bear market, the economy on the verge of a recession, tightening financial conditions, layoffs ticking up, and mass political disapproval across the developed world, you would think they would tread lightly. Instead, they ignored the acute pain at the gas pump and supermarket and dissatisfaction from their constituents and doubled down on the same policies that created the problem. They basically said, like Marie Antoinette, when her advisors said, but the people have no bread. She simply said, let them eat cake. And obviously, if they couldn't afford bread, they couldn't afford cake. And that's exactly what they said in the G7 communique, and the market responded accordingly. Energy up, market down. Why would oil go up when they, quote, double down on failed energy policies? Because the natural reaction to oppression is hoarding, i.e., why invest to produce more oil in a hostile political environment when you could simply pay out all of the cash to yourself and the other owners in the form of dividends and buybacks? Those who don't study history are doomed to repeat it when it's the 7 most important leaders in the developed world who collectively don't understand history and basic economics, or do understand it and completely ignore it. It's not only sad, but it's scary. Some key quotes from the communique, you can read through all those yourself, but the most important one was, quote, we will not compromise our climate and biodiversity goals, including the energy transition, nor on our commitments to phase out our dependency on Russian energy, including phasing out or banning the import of Russian coal and oil. The intent is lofty. We should all be signed up for the hedge. We should all be signed up for moving to greener things, just in case it's not a cyclical thing and it's a persistent thing. Why not take the actions? And if we're wrong, we still win. And if we're right, thank God we did it. The implementation is irresponsible. The transition will take time, and there's no proper acknowledgement of this fact or a sensible timeline by global leadership. While the politicians are oblivious to the effects of their misinformed policies, the market has a perfect and clear understanding. The number one proxy for the green movement is Tesla, down 48% off its recent highs, while the energy sector is still the top performing group, even after the June bloodbath where the E&P names dropped, the index dropped 30% in 2 weeks. So rather than complain about it, what is Warren Buffett doing? Doubling down on his Occidental Petroleum position, he's betting that continued restrictive policy will force small players out of production and only a handful of big producers will survive. In essence, an historic commodity business of price takers will soon become an oligopoly business with multi-player moat and pricing power moving forward. They will get what they say they want. If you think cartels are bad now, wait till you see what's coming based on the actions that the G7 is taking. This is the unintended consequence of all policy regulation, all poor policy and regulation throughout the ages. If you think Facebook and Google are powerful today, just wait until they, quote, regulate tech and push all of the existing and emerging competitors out of the business with an untenable barrage of unnavigable red tape. China has already done it in the past year with their, quote, regulatory tech crackdown. We will see the effects in coming years as Alibaba, Tencent, and JD take more and more market share while the small and emerging players fall by the wayside. Rather than complain about it, what did we do? We bought more Alibaba in the hole when people were getting pushed out of it by uninvestable sell-side notes. We think Buffett is right. We also think there will be better levels from which to reload, as the masses who crowded into energy over the past 4 months just got a taste of the trapdoor opening, as the exploration and production index dropped over 30% in less than 2 weeks, which means many names dropped 50% or more. 1966, our June 16th note, we covered the market similarities to 1994, that Fed regime. Yesterday, an analyst named Jim Bianco was quoted in MarketWatch comparing current conditions to 1966. He says, I think the most comparable bear market we've experienced right now is 1966, Bianco said at a media event on Tuesday. While the Fed was also tightening, was also fighting inflation back in the 60s, the S&P only fell 22% in the 1966 bear market, he said, calling the period just slightly worse than the 20.3% drop in the benchmark since its January 3rd closing peak of basically 4,800, according to Dow Jones market data. So here was the bear market in 1966. Even if a small recession occurs late this year or early next year, which is becoming the consensus view according to Bianco, he doesn't expect a, quote, nasty credit cycle to unfold. I agree with him. I don't think anyone wants to default on their mortgages right now. Their homes are still in the money relative to their debt levels, thanks to sensible reforms on lending, he said. We see every incentive for them to want to stay good on the loans they've taken and keep the terms in place that they have. So, I looked back to compare the market price action and have posted my own annotated analogs below. So here was the run-up to in 1966 off the 62 lows, and you see some comparisons. You have this monster rally off the lows like we had in 2020, some consolidation after about a year, then you run further, then you get this shakeout here where people say it's all over, you run to new highs, and you have this long rollover where in 66 the market corrected 20%. Today we've done 22, and then you have kind of this lower low bottom, and then you recover to new highs over the next year. I think that's a feasible solution. This type of rebound would also be consistent with what happens historically following a terrible first half of the year. The S&P 500 is on track to finish the first half of its worst year-to-date performance in 50 years. MarketWatch data compiled by Dow Jones Market Data shows that the S&P 500 has bounced back after past first half falls of 15% or more. The sample size, however, is small, with only 5 instances going back to 1932, but the average return over the second half is plus 23% following that kind of a drawdown. So as long as inflation expectations continue to collapse, i.e. 5-year break-evens have dropped a full 1% in the past 3 months, from 359 up here back to 259 now, the above-mentioned scenario remains within the realm of possibility despite all of the policy errors. If inflation expectations ramp up again, this line goes back up, then all bets are off. With commodities rolling over, I see that unlikely. They've got to get some short-term solve on energy until the rig count catches up. Now on to the shorter-term market view. Retail investors still bearish. Only 22% are bullish, 46% bearish. It's a little better than last week, but still in the scheme of things, below levels or down at levels during the pandemic lows. Fear and greed still at 25, extreme fear. And active investment managers are only at 20% equity exposure, which is pandemic low levels, which means if earnings come in slightly less bad than expected, and expectations are very low right now, and if any guidance comes in good, they are going to have the biggest panic buying FOMO session that we've ever seen to chase back up, because they've basically sold in the hole, and now they're going to have to panic buy on the way up. So that's that. Earnings have held in. They trickled in a little bit last week, so we got to keep our eye on this. But they're still above 230, which is what we were calling for early in the year, and for this year, and then 251 for next year. So let's see how earnings season comes in. As far as economic data, durable goods orders were better than expected. Pending home sales were better than expected. Wholesale inventories were actually lower than expected, which was positive. Consumer confidence came in lower than expected. That's going to persist as long as energy prices stay high and food prices stay high, which is an input cost. You can't have low food prices without low energy prices. Core CPE, this is the kind of came in worse than expected, but it still peaked several months ago, which we showed on that Bloomberg chart. We'll just show it one more time. So it's rolling over is the name of the game. And then as far as crude, we got a draw. Was that on Wednesday? Yeah, we got a 2.7 million barrel draw. Continuing jobless claims ticked up, so employment is ticking up. Initial jobless claims ticked up, both worse than expected. So Powell is achieving what he wants to do to slow demand. And we'll see what the rig count is tomorrow. But let me just see what it came in at last week. Okay, this is mind-boggling. All right, the rig count has actually jumped up from 727 to 753. It jumped 13 in the last week. If you remember, the pandemic lows was 244. Pre-pandemic, we were at 790. We're back to 753. So that production is going to come on by the end of the year, which we've been saying, but it's on a delayed effect, and some of the things that they're doing in the short term is hurting. But I do see this, which is why we think they're going to be better levels to do what Buffett's doing over the long term with the policies that are in place from the G7 moving forward. So with that said, we're very excited for the Hedge Fund Tips with Tom Hayes 142 is going to be the interview tomorrow from the CIO of Legatum. We'll go into that. Philip Vasilou, and you're going to enjoy that quite a bit and learn how the Chandler brothers turned 10 million into 5 billion over 2 decades, and all the other things that can apply to you if you understand their philosophies and you understand their staying power when they were buying things down 90% and they went down another 70 to 90% in the short term, and they were able to keep building and hold through the period of volatility, whether it was 6 months or 2 years or whatever, and then ultimately make the multi-baggers and compound wealth at an astounding pace. So we'll have that for you live next Thursday, and back to the normal schedule the following week with all the media, etc. So with that said, I want to thank you for tuning in. See you next week. Bye for now. In the meantime, make it a great one.